Welcome to Breaking News to Trading Moves. We are focused today on a headline that's really moving through the U.S. energy sector, all centered around a potential combination that has grabbed the market's attention.
It really has. We're looking at early-stage merger talks between two very large independent shale producers, and our whole focus today is to analyze the implications of this one headline. We're going to distill the potential beneficiaries, the winners, and also those who might face some pressure, the losers.
Right, if this deal goes through, or even if just the theme behind it solidifies.
Exactly. We're examining how this specific scenario could dictate strategies, valuations, and, trading decisions across the entire ecosystem.
And the headline at the center of all this is the news that Devon Energy, that's ticker DVN, and Coterra Energy, ticker CTRA, are exploring a potential combination.
Yeah, and if these talks are successful, you're looking at the creation of one of the largest independent U.S. shale producers.
Which, right there, tells you everything you need to know about the motivation.
It's the pursuit of scale. That's the narrative in the energy sector right now. This allows us to look past just these two companies and see the market mechanics at work.
And even at this early stage, it's a sort of litmus test for how the whole exploration and production sector, the E&P sector, is being valued, right?
It is. Investors are looking for efficiency, they're looking for predictability, and they're looking for size. This combination, well, it aims to address all three of those things. So we're sticking just to the information and the implications drawn from this reported scenario.
Okay, so let's start with the players and the ambition here. We have Devon Energy, DVN, and Coterra Energy, CTRA. These are not small companies to begin with.
Not at all. They're already behemoths in the shale space. But the goal here is to combine their footprints to form a true market giant among the independents.
And this ambition, it feels like it's born of necessity in this current market.
I think so. And you have to stress the current status is early-stage talks. This is not a done deal. It's an exploratory phase.
Which is why we see so much volatility.
Precisely. This phase is characterized by, pretty rapid swings because the outcome is totally unknown. Any rumor involving companies of this magnitude creates a situation where arbitrageurs and long-term investors, well, they all have to pay very close attention.
So for anyone monitoring the energy market, what this headline really does is signal that shale consolidation is back in the spotlight.
It's back in a big way. After a bit of a lull, the whole conversation of who buys whom has returned with force.
And when major independents like DVN and CTRA even talk about combining, the consequences are felt across the whole sector.
That's right. And the most immediate effect isn't even on their operations yet. It's on their valuation comps, their comparables.
Across the entire E&P sector.
Across the entire E&P sector. If the market starts to believe that this new combined company will achieve lower costs and have greater stability, it establishes a new, higher benchmark. A new standard for what an acceptable return and cost structure looks like.
So you're saying if this new DVN CTRA entity is valued at a higher multiple because of that projected efficiency, then suddenly every other producer is being measured against that new higher standard.
You've got it. If they can extract value through synergy, it signals to the entire market that scale is, an untapped source of valuation premium.
And that's what kicks off the copycat chatter.
It immediately generates copycat deal chatter. Analysts start running their models, looking for the next most logical pairings. Who has acreage next to each other? Who runs a lean operation but maybe lacks that deep inventory? This one single headline can accelerate the M&A timeline for the entire peer group.
We saw that immediate market reaction, which you called textbook, but I think it's worth taking a closer look at.
It's the first tell, always. The report noted that Devon Energy, DVN, who's the perceived acquirer, saw its stock go down on the news. Meanwhile, Coterra Energy, CTRA, the perceived target, saw its stock rise.
And that dynamic acquirer down, target up is the classic playbook for M&A rumors. Let's explore the rationale there because it says a lot about investor psychology.
It really does. The target company, in this case CTRA, it almost always trades up right away because the market prices in what's called a takeover premium.
Meaning the market assumes DVN will have to pay more than CTRA's current stock price to get the deal done.
Exactly. To get shareholder approval, you almost certainly have to offer a price above the current trading level. That premium gets baked into the target stock price instantly.
Okay, but why the immediate punishment for DVN, for Devon? If the deal is strategically sound, shouldn't investors reward that ambition?
They should, yes.
Yeah.
Eventually. But in the short term, the market is dominated by fear. Investors immediately price in three specific risks. First, there's the simple fear of overpaying.
Right. Did DVN get a good deal, or did they pay top dollar? The market always assumes the worst at first.
The market often assumes the former, yes. Second, there's a huge execution risk. Combining two massive, complex organizations is incredibly difficult. If they fail to integrate the IT systems, the different corporate cultures, the field operations,
So the promised synergies, all those cost savings, they just never show up.
they never materialize, and the combined company ends up underperforming. That execution risk is a massive hurdle. It's not just about merging two balance sheets.
And that leads to the third big fear, which I think hits a lot of investors directly.
It does. It's the threat to capital return programs. Both DVN and CTRA have been praised by the market for prioritizing shareholder returns. Buybacks, strong dividends.
So investors who own the stock for that dividend are spooked.
A large acquisition often requires the acquiring company to pause or drastically slow down those returns. They have to fund the transaction, pay down any temporary debt, or just allocate capital to the integration costs. So if you bought DVN specifically for its high-yield dividend, you might sell immediately when you hear merger talk. That selling pressure drives the stock price down.
So the market is just pricing the immediate cost and risk of the transaction itself.
That's it. It's a great illustration that M&A speculation isn't just about long-term strategy. It's about the instantaneous pricing of transactional risk versus that takeover premium.
The short-term price moves are all risk and arbitrage.
Exactly. The long-term scale story is where the true value, or lack of it, is ultimately going to be found.
Okay, let's move on to that strategic core then. This combination is being framed as a response to a tougher tape, a challenging market. In that context, scale isn't just a nice to have, it's the defining strategy.
That's absolutely right. A tougher tape just means the era of, rapid, undisciplined growth in shale is over. Investors now demand capital discipline. They want efficiency and predictable free cash flow, and they want it regardless of what commodity prices are doing.
And to meet those demands, you have to be as efficient as possible.
And the most reliable path to that efficiency is size. The logic for combining really boils down to three core, very practical benefits.
The first one you mentioned is lower unit costs. How does combining these two large operations actually result in cost savings that they couldn't achieve on their own?
The savings come in layers. At the very top, you have corporate integration. You eliminate duplicate back-office functions, legal, accounting, HR, IT, which immediately reduces your general and administrative overhead.
That's the easy part to see.
It is. But the real savings come in the field, especially in a place like the Permian's Delaware Basin, where both companies have significant and, in many cases, adjacent acreage.
So if their land is literally right next to each other, how does merging them physically reduce the cost of drilling a well?
It all comes down to operational optimization and bulk sourcing. Just think about it this way. When you drill a well, you need thousands of inputs. You need steel casing, you need hydraulic fracturing services, water, sand.
A huge supply chain.
A massive supply chain. A combined DVN and CTRA operating on adjacent land can now go to suppliers and negotiate for huge, standardized multi-year purchases of frac sand and steel tubing across their entire combined footprint.
So instead of being, say, the fifth largest buyer of steel casing in the Permian,
they might suddenly be the largest, or the second largest. That purchasing power translates directly into substantial, repeatable savings on every single foot they drill.
And that's before even talking about the infrastructure.
Right. On top of that, they can rationalize their infrastructure. They can share water recycling facilities. They can optimize how they deploy their drilling rigs to reduce transportation costs and downtime. These tiny little savings, when you multiply them across hundreds of wells a year, they amount to billions in synergy over time.
That makes the benefit very tangible. It's leveraging volume to cut your input prices. And that efficiency leads straight into the second benefit. More inventory depth.
Inventory depth is so crucial, and the market rewards it heavily today. And it's not just a measure of your total oil and gas in the ground.
It's more specific than that.
It's a measure of the remaining supply of high-quality, economically viable drilling locations, what the industry calls the Tier 1 rock. In a mature basin like the Permian, the best rock is finite. It's a depleting resource. When DVN and CTRA combine, they pool their best premium locations.
And why is pooling that inventory so important for an investor today?
Because investors are no longer chasing growth at all costs. They're chasing longevity and stable returns. If a company can stand up and credibly demonstrate it has 15 to 20 years of high-quality drilling inventory,
it de-risks the entire investment.
it completely de-risks the long-term cash flow profile. It assures investors that the company can maintain production and keep generating that free cash flow for buybacks and dividends for decades, even if commodity prices don't surge.
Whereas a shallow inventory means your production's going to fall off a cliff eventually.
A shallow inventory suggests production will decline, and your costs will go up as you're forced to drill lower quality wells. Combining inventories provides that stability and predictability that big institutional investors crave. It's the assurance that the cash flow won't just suddenly dry up because they ran out of good places to drill.
So scale provides a longer, more reliable runway for capital returns. Okay, finally, the third benefit you outlined is more negotiating power with service providers and midstream companies. This is where external leverage comes in.
Precisely. And this leverage applies in two key directions. First, you have the service providers.
The drilling contractors, the fracking companies.
Exactly. A combined entity has the purchasing power to demand better pricing, but also to secure preferential access to the best equipment, like the highest specification, most efficient rigs. They are now an indispensable customer. That gives them control over their service costs that smaller competitors just don't have.
And what about the other direction with the midstream companies, the pipeline operators?
That's a fundamentally different kind of leverage. Midstream companies invest billions of dollars in infrastructure pipelines, processing plants, and they do it based on long-term volume commitments from producers.
They need to know the oil and gas will be there to fill their pipes for decades.
Decades, yes. So when a massive combined producer approaches a midstream operator, they can commit a guaranteed, predictable flow of product for 20 years or more. This sheer volume and longevity allow them to negotiate lower transportation tariffs and processing fees.
They're not just asking for a better deal.
They're securing the financial foundation for that midstream company's multi-billion-dollar asset base. The consistency and size of that flow are the ultimate bargaining chips. It allows them to reduce their cost to market.
It's clear then, consolidation isn't just about cutting costs internally. It alters the balance of power within the entire U.S. onshore energy value chain.
It really does. It creates a superior, more resilient business model that's designed to withstand commodity price cycles while prioritizing those shareholder returns. That is the strategic promise that's driving these DVN and CTRA talks.
The strategic logic is compelling, but the execution is still highly uncertain. For anyone watching this, there were 4 critical variables to monitor to help gauge the deal's probability and what its final shape might look like.
Right. These are the nuts and bolts of the transaction. This moves the conversation from the initial shock into the financial mechanics. The first and most basic one is simple confirmation.
Meaning, do the companies actually come out and formally acknowledge the talks, or does the news just rely on unnamed sources for weeks?
Exactly. If DVN and CTRA issue a formal joint statement saying, yes, we are in discussions, it immediately escalates the situation. It shifts from rumor to a live transaction.
Which signals a higher probability.
A much higher probability. It triggers detailed regulatory scrutiny and attracts dedicated deal arbitrage funds. If, on the other hand, weeks go by with complete silence or maybe some vague non-denial denials, the market assumes the talks hit a wall or were just speculative. The momentum starts to fade. Official confirmation is the gateway.
Okay, the second variable is maybe the most technical for traders. Deal structure. We need to break down the difference between an all-stock deal and one that involves a cash mix and what that means for different people in the market.
The structure is everything. Let's start with the acquiring shareholder, DVN. If it's an all-stock transaction, DVN issues new shares to CTRA shareholders. For existing DVN holders, that's pure dilution. It lowers their percentage ownership of the new, bigger company.
But a cash mix is less dilutive.
Less dilutive, but it introduces immediate financial stress. DVN would have to raise debt or use its cash on hand, which increases its leverage and its short-term risk profile.
And how does that mixed stock versus cash impact the world of deal arbitrage?
So deal arbitrage funds, or deal arb funds, they typically buy the target's stock, CTRA, and often they'll short the acquirer's stock, DVN, to profit from the closing spread. That's the difference between the offer price and the market price.
Okay.
If the deal is all stock, that arb spread is inherently volatile. It's going to fluctuate every single day based on the performance of the buyer's stock, DVN. The arb fund is basically taking market risk on DVN's stock price. If DVN fall, their profit margin shrinks.
So an all-stock deal is riskier for the arbitrager because the final payment they get is tied to the value of the acquirer's stock when the deal closes.
Precisely. But if a big chunk of the offer is cash, let's say it's 50% cash, 50% stock, that locks in a floor value for their spread. The cash component reduces the market risk for the arb fund. which makes the play more appealing. The primary risk then just becomes whether the deal breaks for regulatory reasons. So that mix directly determines the trading profile and how much hedging is required.
That's a crucial distinction. Now let's talk about the asset focus. You mentioned the importance of Delaware Basin synergies, which an activist shareholder had apparently focused on. Why is that area so vital?
The Delaware Basin, which is in West Texas and southeast New Mexico, is often called the core of the Permian. It contains the deepest, highest pressure, most stacked hydrocarbon layers.
Meaning you can drill multiple wells from one spot, hitting different layers of oil and gas.
Exactly. Wells drilled there are highly productive and have very long lifespans, which gives you superior returns. The fact that the activists specifically highlighted synergies here confirms the priority. This merger isn't a random land grab. It's a surgical move to achieve operational dominance in the most economic acreage out there.
So by combining their adjacent Delaware acreage, they can run their whole drilling program like one massive optimized factory.
That's the idea. They can use shared processing facilities, streamline water disposal, and plan these really long lateral wells that cross what used to be the boundary lines between DVN and CTRA's land.
And that focus also tells us what might happen to their other assets.
It does. It tells us that the combined company's main promise to shareholders will be margin expansion through efficiency, not necessarily just aggressive new production volume. It also suggests that their non-Delaware assets might be seen as peripheral and could be sold off later to streamline the operation and pay down debt.
Okay, finally, we need to think about the broader market reaction if these rumors intensify. What are the knock-on effects we should be watching for?
If the probability of a deal starts to rise, two immediate consequences are likely. First, you should expect sympathy moves among the peers.
So other E&P stocks start to move.
Right. Investors will start looking for other logical targets or acquirers, and they'll bid up the stocks of companies that have adjacent Permian acreage or, just fit the profile of a future consolidation play.
Yeah.
This can raise the overall valuation of the E&P sector.
And the second key reaction?
Volatility in the oilfield services stocks, specifically the ones tied to U.S. onshore rigs. As we've been saying, consolidation usually means capital discipline. The market anticipates that a combined DV&C-TRA will probably run fewer total rigs than the two companies did separately.
So if a wave of consolidation is coming, that signals a potential contraction in the total U.S. onshore rig count.
Yes, and that contraction in demand immediately hits the pricing power of the contractors who own all those rigs. It puts immediate downward pressure on service pricing momentum, the day rates for rigs and for fracking crews.
Because if your biggest customers are combining and promising capital discipline,
it creates a strong headwind for the service sector. It directly impacts their revenue projections. It's a crucial inverse relationship for you to monitor.
Okay, let's pivot now and focus entirely on the groups of stocks and sectors that could gain if this consolidation narrative kicked off by DVN and CTRA really takes hold in the market. There are three distinct categories of winners here.
Right. This whole consolidation thesis is a major tailwind for anyone who can demonstrate scale and stability or, anyone who facilitates the deal-making process itself. The market rewards resilience in this kind of environment.
So starting with category one, the shale consolidators and scale winners. Who benefits just from the idea that bigger is better?
This group gets rewarded because the market applies a higher consolidation premium to their valuation. These are the companies that are perceived as being future-proof, lowest cost, and having the longest life inventory. They're the ones the market trusts to deliver sustained free cash flow year after year.
Let's look at the names flagged. Naturally, Coterra Energy, ticker CTRA, is right at the top of that list.
Well, of course. CTRA is the immediate winner as the target in this specific rumor. They are positioned to receive a takeover premium. And you have to remember, Coterra itself was formed through a major merger, the combination of Cimarex and Cabot. They have very attractive assets, especially in the Permian and the Marcellus Shale, which makes them a premium target. This rumor is an immediate catalyst for their stock price, no matter what the final deal structure looks like.
Then we have EOG Resources, ticker EOG. EOG is often called the gold standard in the E&P space. Why does this consolidation talk benefit them, even if they aren't directly involved in this merger?
EOG basically embodies the virtues that consolidation is trying to achieve. They were pioneers in focusing on what they call premium drilling. They only target projects that meet very strict return hurdles, even in low oil price environments. They have a massive, deep inventory across multiple top-tier basins, and they are masters of capital discipline.
So when the market narrative shifts to praising scale and efficiency,
EOG, which already is scaled and efficient, sees its valuation premium expand even further. Their stock acts as a kind of benchmark for quality that benefits when the entire quality segment gets a lift. They are what other companies aspire to be.
And the third name on this list is Diamondback Energy, ticker FANG.
FAAN is a pure-play Permian operator that has been extremely acquisitive itself. They've used their stock as a currency to execute multiple deals, all to solidify their position in both the Midland and Delaware basins. Because they're already large, focused, and known to pursue scale, they are seen as a beneficiary of this overall valuation uplift for the big players.
They're viewed as one of the success stories of this strategy already.
They are. They fit the profile of a low-cost producer that the market will continue to reward as the emphasis moves away from the smaller, less efficient players.
Okay, moving to category 2, midstream and infrastructure linked to core basins. Why do pipeline companies like Kinder Morgan, Williams Companies, and Energy Transfer benefit when E&P producers merge? It seems a step removed.
It's all about the stability of their contract base. When two producers combine and then promise to high-grade their development, meaning they're only going to focus on their best rock for the next 15 years, they're guaranteeing a stable, predictable, long-life volume of throughput for those midstream operators.
Because pipelines are huge, expensive assets, and their value is tied to the long-term contracted volume they transport.
That's it exactly. A stable, scaled producer is a much better, lower-risk counterparty than two smaller, potentially less stable companies. The larger the producer, the lower the perceived risk that a volume commitment will fail years down the line.
And that increased certainty helps the midstream companies.
It allows them to maintain or even expand their transportation tariffs. Let's look at the names. Kinder Morgan, KMI, is massive, with pipelines all over North America. Williams Companies, WMB, is a specialist in natural gas gathering and processing, which is critical in shale plays. And Energy Transfer, ET, is another integrated giant.
And what are the specific kinds of contracts that benefit them here?
They rely on what are called take-or-pay contracts. These require the producer, like a combined DV and CTRA, to pay for transportation capacity whether they actually use it or not.
So it's guaranteed revenue for the pipeline.
It is. When a massive consolidated producer signs these long-term commitments, it de-risks the cash flow of KMI, WMB, and ET. It supports their dividends and their growth plans. Consolidation removes uncertainty from the supply side, which is inherently positive for the infrastructure owners.
Okay, and finally, category 3. Deal-making beneficiaries, the advisory and capital markets firms. This is a very direct fee-generating benefit.
This is the financial ecosystem side of the transaction. A major M&A event like DVN-CTRA acts as a powerful incentive for the rest of the industry. Competitors feel compelled to merge or acquire quickly themselves, which leads to a pull forward of deals that might have otherwise taken years to happen.
And all that activity generates fees.
All that activity generates fees and flow for the major financial institutions.
Yeah.
You're talking about advisory fees for valuing the assets and structuring the transaction. Then there are financing fees. If DVN uses cash or bridge loans, the banks get fees for underwriting that debt.
And there's also hedging.
Yes. Finally, the new combined company often needs to execute new hedging programs to manage the commodity price risk of their much larger production volume. That generates fees in their capital markets divisions.
The names here are the ones you'd expect. Goldman Sachs, GS, JP Morgan Chase, JPM, and Morgan Stanley, MS.
They're the established giants. They dominate large-scale corporate advisory. They have the balance sheets to provide the financing and the expertise to structure these complex transactions. Their profitability is directly correlated with M&A activity levels in the energy sector, so they are clear beneficiaries when the consolidation theme heats up. It's a fee windfall, essentially guaranteed by the sheer size of the transaction.
Now for the flip side of that coin. If consolidation creates advantages for the big players, it must simultaneously create disadvantages for others. Let's detail the 3 categories of stocks that face pressure from this merger talk.
Absolutely. Recognizing the losers is just as important as it helps you understand where capital might be exiting the sector. This pressure is often based on risk perception and structural competitiveness.
So let's begin with category 1, acquire risk stocks. We touched on this earlier, but let's go deeper into those risk factors.
When a company is perceived to be the buyer, that immediate sell-off is driven by the market, pricing in the high costs and risks of a complex integration. The fear is that the potential acquirer will actually destroy value, not create it, through poor execution.
So the market fears distraction, high debt, and the suspension of buybacks and dividends.
All of the above. And Devon Energy, DVN, is the primary name here, as the perceived buyer in the CTRA rumor. Their initial stock decline reflects that immediate skepticism from investors asking, will the synergies DVN promises actually materialize, or will the costs of this deal just swallow all the benefits? It's a classic risk premium being applied to the stock.
We also see Occidental Petroleum, OXY, listed here. Why is OXY vulnerable to this acquirer risk pressure when the DV and CTRA rumor surfaces? They're not even in this deal.
OXY gets included because of its recent history. Their massive, highly leveraged acquisition of Anadarko Petroleum a few years ago serves as a kind of cautionary tale in the energy space. That deal was heavily criticized for its high price tag and the enormous amount of debt it required.
So it's a reputation thing.
It is. Because OXY has demonstrated a willingness to be very aggressive in pursuing scale, whenever the M&A conversation heats up, the market instinctively treats OXY as a potential risky acquirer all over again. Their stock can face sympathy selling because of the perceived probability that they might announce the next big risky deal, even if they have no current talks underway.
And then we're back to Diamondback Energy, FA and GOE, which is appearing again. It was a winner in the scale category, but it's a potential loser here in the acquirer risk category. That seems complicated.
This dual categorization is arguably the most important dynamic for you to grasp in this environment. FA and GOE is structurally a winner. They are efficient, they are scaled, and they benefit from the general valuation uplift.
But you're also an aggressive acquirer.
They are also an aggressive acquirer. The moment the consolidation narrative intensifies, the market prices in two possibilities at once. One, they are the safe, scaled player. And two, they are the highly probable next buyer who might overpay or pause dividends to fund a transaction.
So the good news, their scale and efficiency is being weighed directly against the bad news, the risk of a sudden, maybe dilutive acquisition.
Correct. The market is asking, is FANG using its highly valued stock wisely, or will they leverage up to buy an asset that doesn't meet the high return hurdle we expect from them? This short-term fear drives volatility and can put selling pressure on FANG that other, less acquisitive scale players like EOG might avoid.
Okay, that makes sense. Let's move to category 2, smaller E&Ps without scale. This sounds like the structural victim of the whole bigger is better theme.
It really is. If DVN and CTRA can achieve efficiencies that drop their operating costs by, say, 10 or 15%, it raises the bar for everyone else. Smaller producers, often focused on a single basin and lacking the purchasing power of the giants, immediately face what's called multiple compression.
Let's define multiple compression clearly for anyone watching this space.
A stock's valuation multiple is the ratio of its market price to its earnings or its cash flow. When we say multiple compression, it means investors start valuing the earnings of smaller companies at a lower rate than they value the earnings of the giants.
And why is that?
Because the smaller companies simply cannot achieve the same low unit costs, nor can they guarantee the same long-term inventory runway. They are perceived as being structurally disadvantaged in a price-competitive world. So investors flee from that perceived fragility, and they gravitate toward the large, secure platforms, leaving the smaller names to trade at a permanent discount.
This essentially starves the smaller E&Ps of the capital they need to develop their assets.
Exactly. If the primary trend is scale, these companies are left on the outside looking in. They become vulnerable to two outcomes. Either they're forced to merge themselves, often from a position of weakness and at a discount, or they just face permanent valuation impairment as their cost structure is deemed uncompetitive.
The names flagged in this category include SM Energy, ticker SM, Callon Petroleum, ticker CPE, and Vital Energy, ticker VTLE.
Right. These are all companies that typically operate with less overall scale than the giants. SM Energy, for example, is primarily focused in the Permian in South Texas, but their relative size and inventory depth are just dwarfed by a potential combined DVNC TRA. Callon Petroleum and Vital Energy face very similar challenges. When a DVNC TRA is negotiating rock-bottom rates for services, these smaller companies have to pay higher rates, which increases their operating costs and directly reduces their margins. That structural competitive gap is what drives the negative sentiment.
Got it. Finally, category 3. The onshore drillers and contractors who are sensitive to rig count discipline. This is the service sector getting hit by the consolidation.
This is a direct consequence of that pursuit of synergy we talked about. We're back to capital expenditure control. When DVN and CTRA merge, they eliminate duplicated field offices, logistics teams, and crucially redundant drilling programs. They won't need two separate teams to drill adjacent pieces of land. They'll optimize the entire combined footprint.
So efficiency equals fewer rigs needed to get the same amount of product out of the ground?
Correct. A combined entity needs fewer total rigs to maintain its production profile because they're running them more efficiently and focusing only on the highest return wells. This reduction in the total number of U.S. onshore rigs directly cuts into the demand for drilling services and equipment.
And the excess supply of rigs puts pressure on pricing.
The resulting excess capacity immediately places pressure on the pricing power of the service contractors. We are talking about the day rates that companies charge to rent out their highly specialized rigs. When demand softens even slightly, service companies are forced to compete on price, which leads to a flattening or even a decline in day rates. That is a severe headwind for their revenue growth.
The drilling powerhouses flagged here are Helmerich and Payne, HP, Patterson-UTI Energy, PTN, and Nabors Industries, NBR.
Yes, HP, PTEN, and NBR are major players in the U.S. land-based drilling market. HP operates a top-tier fleet of high-specification rigs. PTN provides both drilling and pressure pumping. NBR is a global provider with huge U.S. exposure. All three rely heavily on the capital spending budgets of the E&P sector.
So if their biggest customers are now promising Wall Street that they'll be more disciplined with capital,
it's a negative for the service provider's near-term earnings outlook. Their fortunes are intrinsically linked to the rig count, which consolidation, by its very nature, is designed to reduce.
that gives us a full 360-degree view. The CTRA discussion isn't just some internal corporate event. It immediately redraws the lines of profitability and risk for producers, infrastructure owners, banks, and the service companies alike.
It serves as a near-perfect microcosm for understanding the strategic priorities that are currently driving the entire energy market.
This has been a really comprehensive look at the mechanics behind the merger talks between Devon Energy and Coterra Energy. To summarize this potential combination, it strongly validates the industry's strategic pursuit of scale in U.S. shale.
And that validation influences valuations across the E&P space. It supports the long-term infrastructure plays, but it also places immediate valuation and operational pressure on smaller competitors and the service companies that rely on high capital spending.
We've isolated the key variables that will determine the outcome official confirmation of the talks, the choice between all stock versus cash in the deal structure, and the resulting impact on the overall U.S. onshore rig count and capital discipline. These are the elements you have to watch as the story evolves.
And as we conclude, we should probably leave you with one final thought to consider, building on the specificity of the information we've looked at.
Please.
Given the reported activist focus on the Delaware Basin synergies, this entire move reinforces a new performance benchmark for U.S. shale. The ultimate measure of success for any combined entity going forward will not be achieving the highest total production volume. Rather, it will be the ability to relentlessly extract maximum sustained efficiency and high returns from the best quality assets, showcasing true capital discipline. That intense focus on margin expansion over volume growth is the new key to valuation in this sector.
A compelling analysis. Thank you for guiding us through the implications of this major market event.
My pleasure.
Just ask. As always, a necessary note. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Until next time.